The latest move from the Fed it just skyrocketed housing demand, but we've already been in a huge rut. For those of you that have been keep coming to this channel, know that I've been covering the demise of the housing market. So it's really a question: is this rate cut too late? And with all of this, why are we seeing the stock market skyrocket in flight when we have such negative housing sentiment? Now, first, we're going to get into the demand shock that we just saw from these rate cuts. Because once the rate cuts came down, the mortgage demand surged literally 30% in 1 week. That is absolutely massive. And now, of course, the time we saw them surge the most was right when Big Donnie T came into office. But now, will this improve affordability? And this is a great thread that I'm going to go through, and I agree with them where I don't think it will, because mortgage rates declined sharply since the Fed's decisions to cut rates. But back in 2022, we didn't see like many rate cuts come in, and then when we did, the prices didn't go down quite as much. And now this is what we're seeing somewhat of a quote unquote normal market, where houses are on the market for 50 days at least, and then we start to see some transactions come through. It's not like what we saw during the cerveza sickness, where houses were flying off the shelves, 100,000, 200,000 over asking. No, 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 not so fast. We're seeing a somewhat of a normal market. And because we're seeing that, these mortgage rates declining, I don't think they're going to decline quite as sharply as people think. And last week, mortgage rates posted their biggest weekly drop in 12 months. And that's when we saw demand get up pretty good. But, at 7.08% in early 25, the average 30-year rate mortgage is now down 6.35%. But that's exactly the problem. These mortgage rates are down enough to spur demand, but not restore supply, which is exactly what we're seeing, right? I mean, it's at the end of the day, it's a supply and demand issues. So I think that at the end of the day, the housing market is still going to be seeing some slowness, and it's going to take a while to recover, because I'm going to keep getting into all of this. But for those of you guys who know and have been coming to this channel, please hit that subscribe button, because 98% of you guys literally are not subscribed. But help me get to that 1K. And if you look at the 2008 search terms of Google, we are seeing help with mortgage at 2008 levels. Now, I know anytime you hear at 2008 levels, you're a little skeptical, but at the same time, we have ChatGPT, we have all these other search engines, Bing, DuckDuckGo, what have you. Google and their search engines are actually used a little bit less than they were in 2008. So seeing help with mortgage at the Google search terms get to 2008 levels, I think is even more of a worry than we should be cautious of and aware of what is going on. But let's keep going through this great thread here, because the monthly mortgage payment versus existing mortgages are still going up, because the affordability cost is it costs $800 more per month to buy a house with a mortgage than to keep your house with that mortgage. So the majority of homeowners have rates that are still well below the current levels. In fact, majority of mortgages are below that 4% level. See, as I said, this is why the vast majority of homeowners will have a financial disincentive to move, because even though we have mortgage rates lowering, they're still not low to the point where people are going to move and, shift out of these current homes that we see. So with the home prices, they need to come down at least 80%. No, excuse me. They need to come down because 80% of the borrowers pay interest rates below 6, and 73% have rates below 5. So we need to see the mortgage rates start to come down. And you guys know I've shown this chart before, where the existing home prices are now more expensive than new homes for the first time ever, because the new homes now cost $33,500 less than existing homes. So if you own a home with a 3% mortgage and want to move to a new home, your rate will more than double. And so that's why they're holding on to these houses for dear life. And then we're seeing they're a record high. 1 out of 3 homes for sale are now new homes. So it's before it was a supply issue where everybody was saying, oh, the builders, they need to increase the supply. This is what hurt them the most, was the potential of having, all of these builders come in and there's too much supply in the market, not enough buyers. The reality is there is a lot of buyers, but people are seeing that the quality of homes on these new houses is just pretty low, to be quite honest. And so because they're low and they're seeing, the fact that, the existing home buyers or homeowners have such low mortgage rates, they're like, why the hell would I need to buy and switch and move out of a new place? So the rate cuts alone won't bring relief to the housing market. It'll be something else, right? So the rate cuts alone, we're going to see, they need to bring it down to lower and lower mortgage rates in order for that to reach that sweet spot. We need that right around that 4.1% mortgage rate. And we're not even close to that yet. We're still at like a 6% more average mortgage rate. So the 4% are distant. With inflation back on the rise, the Fed will cut interest rates will be limited in scope. The results will be moderately lower rates with a spur of demand, but not more supply. This sets up for even higher home prices ahead. And it believes that a highly unlikely external factor will spur demand. So, I mean, the demand is going to keep going up, but people just aren't going to be moving at all. And then on top of it, we have the S&P 500 going literally on a generational run. It's been on the best 5-month run that we've ever seen in history. Since the lows of April, we've seen the S&P 500 up 35% and has been closing at all-time highs. So is this one of the hugest asset bubbles in history? Many believe so, and I'm a part of that camp. I think that this is a big, giant asset bubble, to say the very least. Now, with this asset bubble, right, we got to be cautious with when we're getting in the potential market, because the asset bubble runs to a area where it's like, okay, if we're in an asset bubble, things aren't good to buy. But the U.S. keeps buying up their own treasuries, buying up their own debts, which is another little wrinkle of there. So they're essentially using this crypto market to fund the U.S., even though we have, some, let's call it, ups and downs in the market, to say the very least. So the Fed's rate cut will offer that hope, but the home prices are still going to stall. Right? The inventory and the growth is still slowing. So will the housing market crash again? Are we going to see that? Because are we going to see the values plummet? Because everything that I'm lining out here basically lines out that we are not going to see the housing values plummet. We're going to see houses actually stay pretty flat, or maybe even increase in price with this rate drop. So if we're going to see houses decrease and this rate hike, go away, and continue to, look at the overall market and just be like, oh, you know what? We're never getting away from this. We got to keep a very, very close eye on how these rate cuts really affect the overall market, because at the end of the day, housing doesn't look like it's going to crash. With the stock market shooting up and rising, and the Fed looking like they're going to cut interest rates again, I mean, unless housing and the mortgage rates come down to below 4, we're not going to see people buying up houses as dramatically as we saw before. And with the Dixie as low as it is, people are going to fly into assets, but they're flying into more liquid assets comparatively to housing. So because housing is slow moving and the S&P 500, you can get in and out whenever you'd like. I mean, people are going to be flocking to more of these types of assets opposed to, rate cuts and everything else. So when we see rate cuts changing the investment landscape, the economy shifting, this is when, we're going to see unemployment start to increase as well. So I'm going to be detailing all of this. I'm going to bring you guys a live stream literally every single day this month, and I've been doing it. So be sure you're hitting that subscribe button, telling a friend to tell a friend, and hitting that like button for me to help shoot this one to the stratosphere. I'm going to keep this one short and sweet on this Friday afternoon as we're coming in at market close. So thanks you guys all for tuning in. And Chris, I'm with you. I'm staying on. I mean, I don't know. I don't have the capital, the dry powder to buy right now. So make sure you guys smoke the like and hit the subscribe button so maybe I can get a sponsor or two and start getting some dry powder to start buying some of this stuff with you guys. But I'll catch you guys all at the next one.